Before we get into today's episode, if you have not registered for the free live training on March 26th, I want you to do that today. It's called How to Build an Investment Portfolio Without a Financial Advisor or Living Like You're Broke. Thursday, March 26th, 7 p.m. Eastern. Free, live, and everything we're talking about today connects directly to what I'm teaching in that training. The link is going to be in the show notes. If you cannot make it, you still need to register so that you can get the replay. There's going to be a lot of discussion, a lot of training, a lot of learning. It's all free, it's valuable, and there are going to be a lot of answers to your questions. It's an opportunity. If you have questions, send them in. If you're going to be working and you can't make it at that time, your questions will be answered. You'll get the replay. Of course, it'll be anonymous. I'm not going to call you out, but I am going to answer your questions. So make sure you register for the free live training. It is Thursday, March 26th at 7 p.m. Eastern. Got it? I can't wait to see you there. Welcome, welcome. Welcome back to From Middle Class to Millions. Let's talk about your 401k. All right, not in the boring, technical, this is a friggin' snooze fest kind of way, but I really want you to know really what this account truly is, okay? Where it came from, what it's doing or what it's not doing. I want you to understand how you can make it work for you in the kind of way that makes you rich. Do you understand me? So that's what we're going to be doing today. All right, so let's go. Let me ask you this. When was the last time you looked at your 401k? And I'm not talking about just checking the balance, but actually looking at what that thing says, right? Have you pulled it up? Have you read what it's invested in? Have you looked at your fees? Have you asked yourself if this actually makes sense for where you are right now? And I know I told you to do this in last week's episode. All right. And I know you may not have done it, and that's okay. I'm not here to shame you, but I really want you to understand this account because it's so important for you to not only understand this account as a retirement account, but once you understand this account, you're going to understand other accounts. You're going to understand the IRA. You're going to understand the brokerage account. You're going to understand the 529. And the reason why I'm talking about this one is this is usually, not always, but usually most people's introduction to investing. All right. And honestly, most people don't know what the heck's going on in this particular account. Right. And so I know that you guys are smart and you can spend hours researching a lot of things. And I'm not faulting you for that, but I want you to give me a little bit of time on this podcast and at the webinar understanding what this account is supposed to do for you. Because if you can spend time researching a vacation or comparing prices on a car, or like me, looking for a red light therapy mask, or whatever the case may be, I want you to be able to put some time towards this fund that's supposed to last you for the last 20 or 30 years of your life. Okay? I don't want you to sign up for it and never look at it again, and it's not able to serve you when you need it. So I want to bring it to the front so you can learn what to look for or why it matters. And this is exactly what we're going to be talking about today. All right. So we're going to cover where the 401k actually came from and why the history of it matters. Okay. And not in the boring way. We're going to talk about what your 401k is doing or not doing right now. And we're going to think about allocation and fees and intentionality. And I'm going to define some of the terminology that you hear that you're like, what are these people talking about? I'm going to break it down and make it very simple and digestible. And I'm going to also cover why your 401k is simply the starting point, but it is definitely not the finish line. All right. Okay. Let's start off by talking about what a 401k is, because you need to understand what came before it. Now, most of you already know this, and I'm sure if you are a millennial and definitely if you're a Gen Zer, you probably don't know anybody who has one of these who's your age. And what I'm talking about is what went on for most of the 20th century, what was the dominant retirement model in America, and that was the pension. Most of you guys, if you're millennials or younger, and even some of the Gen Xers, you don't know anyone your age with one of these. And it was this pension, a defined benefit plan. See, what happened before is that most people worked for a company, sometimes for decades, and when they retired, the company paid them a monthly check for the rest of their life. Okay? The benefit was defined. This is the amount you're going to get. The day you walk out the door, you're going to get this amount until you die. You knew what you were getting. And the employer was responsible for managing the investments. They held all the risk, and they were responsible for your retirement income. You gave them, 40 years of your life working for them. They were going to take care of you until you died. That was the deal. That was the plan. And the burden was entirely on the company. Okay. But then in 1978, Congress passed the Revenue Act of 1978, and buried inside of it was this little provision. And it was Section 401K, Section 401, Paragraph K. Sound familiar? And this provision allowed employees to defer a portion of their money, their income, their compensation on a pre-tax basis. Okay? So one paragraph in this tax bill that almost nobody noticed, right? This occurred in 1978. 2 years later, in 1980, a benefits consultant named Ted Benna was reviewing the provision and realized it could be used to create this savings plan that was tax advantage for both the employees and the employers that could contribute to it. His own employer, Ted Benna's own employer, adopted it, and that was the first 401k plan that was born. Ted Benna has called himself the father of the 401k, but in his own words, he himself said he's created a monster because what happened next was not what he intended. He did not expect that throughout the 80s and the 90s, that corporations saw this 401k as a way to say, I don't have to do this pension crap anymore. This was a way for them to get out of the pension system. Pensions were expensive. They were liabilities on the balance sheet of these companies. They required all this professional management. They had to hire all these teams to manage these pensions. And there was all of this risk that was indefinite, that was associated with the pensions. And what the 401k did is it let the companies shift all of that. I've got to pay you for the rest of your life once you leave the company, to simply contributing to an account and let you take it. Let you manage the rest of it. And so over the next couple of decades, pensions started to disappear from the private sector, especially. And this, I would say, accidental tax provision became the primary retirement vehicle for most working Americans. So what does that mean, right? Companies are no longer responsible for your retirement. So what happened is the entire shift of the retirement and the risk associated with it moved to the employee. So under the pension, the employer absorbed all of the losses. Anything that happened with the market, when the market tanked, that was in the employer's hands. Under the 401k, it's on you. If the market drops, that's your retirement account that's dropping. If you make poor choices, that's your problem. It's no longer the employers, right? The responsibility as well as the risk went from the corporation, the company, to you. And guess what? Nobody told you about it. Nobody gave you a training. No, there were no memos that were sent out. The entire retirement landscape and the model changed, and the employees were left to figure it out. But the thing is, the 401k was never designed to be your entire retirement. It was a small paragraph, a tax provision that became a retirement system by accident and by convenience. And it was convenient and is still convenient for the corporation. So I'm telling you this because I want you to understand the system that you're working within. I don't want you to be blindsided in any way, shape, or form. I want you to understand how this thing came about and why pensions have disappeared and how the onus is now on you to be responsible for your own retirement. Now let's talk about what a 401k truly is. So you now know where it came from, what it meant to corporations, and of course to you, the employee, now that the corporation is no longer responsible for you. How about somebody telling us what it is, right? Like, what is this thing? First of all, a 401k is not an investment. It's an account. It's like a container. And if you go back a couple episodes, I talk about the different containers in the stock market, right? And the 401k is just another account, another container. What matters with the 401k is what's inside the container, because that determines whether your money is growing or it's stagnating or if it's just being absorbed and eroded by fees. So what I want you to know about this container is a couple of things, or three things. One, there's a default investment that is in the container. Secondly, there are fees associated with the container. And thirdly, your contribution rate to the container has an impact on what happens with your investments. Okay, so if you didn't make a specific investment election when you started your new job and you enrolled in your 401k, or if you were auto-enrolled, a lot of companies have kind of forced employees into automatically enrolling in their 401k, and you have to elect to get out of it because they're really trying to encourage people to save for retirement. If you weren't paying attention and didn't make your own choices, you were most likely, your money was funneled into a target date fund. Okay, something like a 2045 or 2050 fund, and they're named based on the approximate year that you may retire, right? These funds automatically shift from being really aggressive to really conservative as you approach your retirement date. So they're really aggressive in the beginning, really aggressive investors in the beginning, and then they taper off to really more conservative as you're approaching the time when you need the money. These are not bad investment vehicles, okay? I don't want you to think that the default, the target investment funds are bad. Target date funds are bad investments. They're really convenient, but they're not personalized. And that's the thing, right? Like a target date fund doesn't know what else you own. They don't know if you have other assets. They don't know your risk tolerance. They don't know your goals or when you actually want to retire. It's really just this generic default fund that's based on your age, and it's designed for the average investor. Now, I don't know how many of you think you're average. I don't think you're average. And I've worked with a lot of women, and I can't say the average woman wants to do this and that and this. I can't say that. Each one of the women that I've worked with, they're specific people with specific goals. They're all different. And there's a real chance, right, that your money could be sitting in that default generic average investor target date fund right now without you knowing it. So I want to bring that to your attention because I think it's important for you to understand how these investments kind of funnel people into these categories. The second thing that I want to talk about are the fees. Every investment inside your 401k has fees, and these fees are known as expense ratios, right? And it's pretty much the management, what it costs to kind of the administrative management of the fund that you're investing in, right? So a percentage is taken out automatically each year, whether your account goes up or down, okay? It's this percentage that you never see on the bill, but the fee's just taken. And sometimes you'll see slightly lower growth than you would have had without it. So I know I gave you the example in a previous episode of my client Tina and how the fees were really eroding her growth, right? And we calculated that if she didn't do anything about said fees, over the next 10 years, she would have lost $140,000 to fees. For what, right? So think about it. Like if you have a $100,000 portfolio and that's $100,000 invested, And over the next 30 years, let's say you get an average return of 7%. Okay. Over the 30 years, you get this return of 7% on your money. All right. Not bad. But the difference between a 0.1% expense ratio and a 1% expense ratio is roughly $100,000. $100,000, 6 figures, not lost to a market crash or not lost to taxes, simply lost to fees. And so these fees that you're probably paying right now without you knowing are out there. They exist. Go look it up. It's on your account statement. It's in your funds information. It's important for you to know that. And these are the kind of things that when you enroll, nobody tells you about. Nobody teaches you. Nobody talks about this stuff. The third thing that I want to cover with you is the contribution rate. And this is the amount that you get siphoned out of your gross pay if you have a traditional 401k that comes out of your gross pay every 2 weeks. Now, a lot of you have set this contribution amount up, this percentage, at whatever you needed to do in order to get your employer match, which is great because, yeah, the match is a part of your benefit package. You are entitled to it. That match can amount to a lot of money. So, yeah, you should at least contribute to the match. But some of you have never gone back and changed it. And I want to really get you to rethink how you think about that match. I want you to reframe it a little bit because the match is just the floor. Like that's the beginning. That's where you enter the game. It's the minimum required to avoid leaving money on the table. Yes, it makes sense to get the match, but that's not a retirement strategy. That's just to get in the game. I want you to know that in 2026, the IRS allows you to contribute up to $24,500 to a 401k. And I'm not saying, I know a lot of you who haven't even started investing, you're like, are you nuts? And I never contributed up to the match. I have to point that out to you. I am a multi-millionaire. I never contributed up to my max, back in the day. Never did. I'm not saying not to. I'm just saying that you can still, because this is strategic, you can still become a multimillionaire without contributing up to the maximum of your 401k. But you need to know that that's an option for you, right? And if you're 50 or older, you can add another $8,000 in catch-up contributions. And then what are you at? $32,500. Most people only contribute a fraction of what's possible. Only a fraction. And not because they have other investments that they're putting their money towards. It's because they're not even aware. They're leaving all of this tax advantage growth behind every single year, leaving all of this opportunity, all of this room behind every single year because they don't know and because they don't have a strategy. So I'm not saying that you have to max it out or you have to max it out tomorrow, but you need to know your number. You need to know the gap between where you are and what's possible. You need to have a strategy for your retirement. And if you're just doing, the employee match, which for some of you could be 3%, 4%, 5%, that ain't going to get you there. It's just not. So I want you to make a conscious decision about whether or not you want to contribute more to your 401k, to your retirement fund. I'd rather you do that than leave it where you set it years ago and not look back and not have a plan. All right, let's talk about allocation because this is something that most people don't really know much about. And again, this is, you're not getting any education on this. This financial literacy is so very important. And I know that there's a lot of information out there and it gets really overwhelming, but this is what I talk about with my clients all the time. This basic financial literacy. And it doesn't seem basic to you because you're like, you hear all of this swirling around and nobody's explaining it to you. But once you get into the flow and into the community of hearing this language and you understand it, you're going to be like, oh yeah, I totally get it. I totally get it. So I'm always going to define what these terms are, because I know that like Wall Street likes to use all these terms to confuse you and bamboozle you. And that's not what it's about right now. It's about you understanding what to do and how to make decisions that serve you for your future, right? So allocation is how your money is divided across the different types of investments inside your 401k. Remember, the 401k is a container, and you put money into that container, but you allocate the money to different types of investments. So you decide, you choose what types of investments within the container you're going to put your money in. So it could be stocks, it could be bonds, it could be domestic, it could be international, it could be growth oriented versus conservative. It really kind of determines how much risk you're taking and how much potential growth you have. So two people can have the exact same 401k balance right now today and end up with dramatically different amounts at retirement. And it's not because one contributed more, but because their allocations were very different. And that's how much that matters. And that's why you will hear, I'll have someone get on a call with me and say, oh yeah, my investments in my 401k, they went up 2%. And I'm like, what the hell has this person been doing in 2025? And it's like, this is an abomination, because they don't know that when other people, their investments went up 22%, 24%, their investments only went up 2%. And I think that's unfair that they didn't have that knowledge and that they lost all that potential growth in their investments, right? So this is why it's so important for you to understand the allocation, and why it's so important for you to be in community with people who understand the language, speak the language, understand how this works, and are willing as well to share this information with you. Now, there's a general principle about investing that stands, right? And the principle is pretty straightforward. The more time you have before retirement, the more risk you can afford, because you have time to recover from all the markets flip-flopping up and down, the downturns and all the craziness that goes on. And so the idea is, the closer you are to retirement, the more you want to protect that, right? You want to protect what you've built, and you want to shift towards things that are more conservative. And that makes sense, right? Like, if you know that you're going to need your money in the next year or 3 years, you're not doing too many risky things with it. That's the basic idea. But that's a general principle. That's not a personalized strategy. So your allocation, where you put your money within the container, should reflect your money stage, your goals, your other assets, your income stability, and your actual risk tolerance. And when I say your risk tolerance, I don't mean, you see on the news that the market dropped 20% in a correction and you freak out and that's how you respond. I don't mean that type of risk tolerance. I mean your risk tolerance in terms of like, okay, you understand that the market fluctuates and that you're looking at trends. And that's what you are dealing with, right? So I think it's very important to understand that you need a personalized strategy. And although the general principles and the general logic make sense, you need to know what makes sense for you, what's sound for you and your family. So even though most people have this account, this 401k, and most people who are listening to this probably do, that set it and forget it. And you may have heard me talk about set it and forget it. That set it and forget it problem is like the death of a lot of you. Because what people have done is they set it once and then they never revisited it. So they enrolled in a 401k when they were like 20 something, right? And it was really aggressive because they had time. But now that they're 42, their life looks totally different. And the 401k is still allocated like they're in their 20s. And that doesn't make sense. You've got to look back and see, okay, does this make sense for my current money stage? Or the opposite. Some of you have like enrolled conservatively because you were really nervous about the market. You didn't understand it. You were like afraid you were going to lose your money. And 10 years later, your money still is growing so slowly and you're significantly behind, not because of the market, but because how you position yourself within it. Because you didn't understand and you were nervous. And it's like, wait a second, how come I've been contributing for this long and I don't have as much money as the person beside me with a similar income, similar lifestyle, similar contributions? Your 401k is not going to update itself. It doesn't know you've changed jobs or had a child or paid off debt or have different goals, or it doesn't know what the heck you're doing. It sits where you left it. So you've got to make conscious decisions about what you're going to do with it every single year. And you have to be really intentional about it. And intentionality doesn't mean you have to be obsessive. No one's telling you to look at this all the time. I'm not telling you to look at it every week or every time the market moves. That's not a strategy. That's just pure anxiety and nervousness. What I'm talking about, it means like you're going to look at your 401k once a year. And you're going to look at it and you're going to ask yourself questions like, what am I actually invested in? Right? Like, does this allocation still match where I am in life and where I want to go? Like when I mentioned all of those life changes, does this apply to today? Or have there been any major changes in my life that should prompt a revisit? Like here I am, perfect example. My kids are one's in college, one's about to enter college. That's a different life stage for me. They're not totally gone, but they're not right here. You know what I mean? And I'm getting closer to them being more independent. So that's the kind of thing. That's the kind of intentionality. Those are the kind of questions that you want to ask yourself. And you only want to do this annually, right? But you do want to do it, and you want to do it on purpose. You don't need a financial advisor to do this for you. You just need to make the decision rather than just leaving it hanging out there. But you have to have enough financial literacy to do so. And it shouldn't cost you $100,000 in fees for you to just receive the financial literacy necessary to go in here once a year and ask yourself a few questions. So I know out there's a lot of like, the 401k is garbage and da-da-da-da. I disagree. I think the 401k is a really powerful tool. I think that the amount of money in taxes that you can save, like the advantages are significant. And I think ignoring the employer match is foolhardy because it's real. My employer match was $250,000 by the time I left my job. So the compounding growth over time is real. I am not dismissing the 401k at all. Not at all. There are a lot of 401k millionaires. I've made a lot of women millionaires, and I'm not counting their primary residences, the net worth of $1 million, and there are 401k millionaires amongst them. But the 401k has some limitations, right? And you just have to be aware of what they are. The limitations like the contribution limits, that's set by the IRS. You can't determine how much you put in there. If you want to surpass what the IRS sets for you, there's some limits there. And sometimes the investment options, what you can allocate the money to in that container, they're limited because it's whatever your employer's plan offers. You don't have access to the open market, right? You have to only pick what is given to you by your employer's plan. And so that is another limitation. And the thing is, your 401k, it moves with you when you change jobs. It's not the worst thing in the world, but every time you move, you got to make a new decision about, okay, do I roll it into my new employer's plan? Is that an option to me? Do I do a rollover IRA? Like, you've got to make some decisions about it. So on its own, it's not a complete retirement plan, and it's not a perfect plan, but it's a starting point. And you need to understand what to do from that starting point. But once you get it, right? Once you get it, you understand that it works very similarly to a lot of the other containers. Now you can build beyond your 401k. There's so many things that you can do beyond your 401k. Like you can go into a Roth IRA where your money grows tax free. And that means you don't have to pay taxes now. I mean that you pay taxes now. But when you go to withdraw the money, you don't pay any taxes on it. So sometimes when people are thinking that they're going to be in a higher tax bracket later in life. Well, the Roth IRA is one of the most powerful tools that you can use, or Roth 401k, right? There's also brokerage accounts, which is a taxable account, right? Where you pay taxes on that money every time you take that money out, but there are no contribution limits and there are no restrictions about when you can access the money. And the taxes that you pay aren't income taxes, but capital gains taxes. So there's less tax on that money that you take out. So understanding these different containers and understanding what you own and why you own it and kind of how all of it works together, that creates a real portfolio. That's a real investment portfolio. It's not just a collection of accounts you opened at various jobs and in various times of your life. It actually is a true investment portfolio. And it starts by you understanding how just one of these accounts works and getting it going. A lot of you don't think you're investors, even though you have a 401k account. A lot of you say you don't invest in the stock market and you got a 401k. I cannot tell you how many women come to me and say that. So I want you to understand that, look, you are working hard for this money. I want you to really give it the attention it deserves so that it can work hard for you. I know that women come to me all the time, convinced that they're not good at math and they don't understand what's going on and they can't manage their own money and that it's so complex and it's all beyond them. They can do all these other things. And I'm talking smart women, okay? Educated women, women who have businesses, women who work these crazy 9-to-5s, come to me, and what they actually need, right, is financial literacy. They just need the time and the ability to understand their accounts. They want to ask the questions, get the answers, and make confident decisions. That's a skill. Just like any other skill that they have, it can be learned. And no, the women that come to me and say, yes, I need a lot of money to start, false. You don't have to wait until you've hit some arbitrary milestone. I started with $12.50 every 2 weeks, $25 a month. You do not have to have this tremendous pot of cash sitting there waiting to be invested. And if you do, if you have that money sitting in a savings account somewhere and it's not investing and it's not growing and it's just being eaten away by inflation, you need to get started. And no, if you are going to start investing, it doesn't mean that suddenly you have to scale back on your entire life. I refuse to let you do that. It doesn't mean that now you've got to give up so many things in order to get started. Absolutely not. You don't have to live like you're broke. Building wealth, that's built on strategy, not on deprivation. It's the consistent, intentional moves that make a difference in your actual day-to-day life. It does not mean that you have to change anything or everything. And you can do this at any age, at any income, at any starting point. Because what matters is that you understand what you're doing. And of course, that you get started. So let me quickly recap this for you, because I know there's a lot in here. And if you have to listen to this again, I want you to listen to it again. I want you to take notes. But it's important that you get this, okay? Your 401k was never designed to be your entire retirement plan, okay? It was that simple tax provision that turned into a retirement system by accident. And you know what? I even doubt that it was an accident, because once the corporations got that loophole and figured out that, hey, I don't got to do this, I can shift the blame over to you. They did it, and they did it fast. And pensions went away, and 401ks put the risk and the responsibility on you. And now you've got to take it because this is the system we're in. So you better figure out how to work within the confines of it. You got to know what's in your account. You got to know if you have that default investment. You got to know your fees. You got to know your contribution rate. You got to know that the employer match is the floor. It is not the ceiling, and it is not the strategy. You've got to make conscious decisions about your allocation. You don't have to be obsessed about it, but you got to check it once a year. You got to be intentional. You got to let it reflect where you actually are in your life. This is a journey. It can't be something that you set 10 years ago and you've never looked back. And you have to understand that the 401k, the reason why I'm talking about that account is because it's usually the one that people get access to first, right? But it's a starting point. It's a starting point in that whole landscape. You have a Roth IRA available to you. You have brokerage accounts available to you. You have 529 savings accounts for college available to you if it's applicable. You are creating a real investment portfolio. And you can do this at any age without an advisor, without a huge amount of money, and definitely without living like you're broke, depriving yourself and hating every minute of it. This is what I want you to do. I want you, after you listen to this episode, or you can pause it right now and go pull up your 401k. Take a look at it. Find out what it's invested in. Find out your expense ratios. Check your contribution rate. You don't have to change anything today, but I want you to know what's there. I want you to be familiar with what's going on. Because when you intentionally look at it, that's a start. That's the first step. And when you have all of that information, I want you to show up on March 26th. I want you to come to the free live training. How to build an investment portfolio without a financial advisor or living like you're broke. This is where we're going to take everything I've touched on today and we're going to go really deep. You're going to bring your questions and I'm going to answer them. A real live person, not ChatGPT. I'm going to answer your questions. I'm going to walk you through the exact framework I use with my clients. I want you to understand how your money is doing. I want you to be able to build beyond your 401k. And if you have a 401k, I want you to understand what's in it. And if you haven't started, come. Because you're going to get started. I'm going to show you how. I want you to be able to create a real portfolio for your actual life. So go ahead and register at the link in the show notes. March 26th, 7 p.m. Eastern. It's free. I will see you there. And oh, by the way, share this episode with a woman in your life who needs to hear it. Because I know there are women out there who need to hear it. You want to know why I know? Because women live longer. And you want to know what? Because you're going to live longer than men. Sorry, but that's the nature of the beast. You better make sure you have money to outlive that man. All right? And if you don't have a man and you are single or you're living with another woman, the two of you better figure out how to make your money last. Come to the webinar, Thursday, March 26th, 7 p.m. Eastern. Can't wait to see you there. And before that, I'll see you back here next Thursday. Take care.